Are you a rational person?
Usually am, but sometimes not.
Yes.
Are you sure?
Yeah, I think so.
I think so. I don't know.
Yeah, I would consider myself a rational person. Most of the times. Yeah.
No.
No.
Yes. No. Yes.
Yes, I am,
Why?
because I believe to think about things in a logical manner.
All right. Behavioral economics is the study of investors' individual and group behavior in the markets. Unlike in traditional economics, where decision-making is assumed to be entirely rational and based on logic, behavioral economics describes investors' behavior as irrational, emotion-driven, and influenced by cognitive biases. By studying this controversial field, we can learn how to detect or minimize the psychological biases that affect us and start making more informed as well as accurate investment decisions.
In 1979, the psychologists Daniel Kahneman and Amos Tversky discovered a relationship between psychology and market fluctuations, giving rise to the new field of behavioral economics. They challenged the basic assumptions of human rationality inherent in the classical economic model of decision-making. Their work focused on three main areas: risk attitude, mental accounting, and overconfidence.
In the 1980s, behavioral science professor Richard Thaler extended the scope of the field by making stronger connections between psychological and economics principles. In 2017, Thaler was awarded the Nobel Prize for Economics for his contributions to the field. Attempts to describe the irrational behavior of investors have led economists to distinguish between different biases affecting our decision-making process. Let us explain the most important ones that you have very likely been influenced by before.
First, the tendency to weigh losses more heavily than wins is called loss aversion. We are more likely to sell a winning stock than a losing one, and we hold on to the failing investment desperately, hoping it will gain value again.
This concept similarly describes regret aversion, a bias causing you to hesitate with selling the losing stock, to avoid the pain of a sure loss and admitting that you made a bad investment. A vicious cycle can succeed from avoiding regret by not selling and becoming even more regretful when the stock value continues to drop.
When you base your decision on a recurring pattern in a random sequence, estimating the future based on irrelevant data is also called anchoring. When you wait for your losing stock to break even at the price you bought it at, the initial price is your anchor, even though this number has nothing to do with the value of the shares 2 weeks later.
Herding is a phenomenon perfectly described by its name and relating to the human need of belonging to a group. In a world of uncertainties, what is easier than copying what others are doing? By following others, we try not to miss an opportunity and avoid being stuck alone in the case of a bad investment.
Self-control is a cognitive bias that doesn't mean we have no control about ourselves. It describes the fact that we often believe wrongly that we have the power to influence random results. For example, when you think throwing a dice hard enough will make it a 6. Self-control relates to an even stronger bias that most investors are guilty of: overconfidence. With this tendency, you overestimate your own ability to force a certain outcome that can have a rather serious effect in any life situation. For investors, overconfidence can leave a great hole in their pockets and ego from making uninformed decisions. Remember that time you lost a sum of money on Corner Trader when you were too sure about your fortune cookie skills? That is what we are talking about. The truth is, we actually have no clue about what will happen next, especially when we believe we do not need to make detailed analysis in order to make successful decisions. Investors often overestimate their ability to predict future prices. In the case they are wrong, the decision is simply attributed to bad luck.
Stocks are said to do best when investors are lower in confidence. Following pessimistic periods when fearful and less confident investors step back into the market and increase demand for undervalued shares, causing a bull phase of optimism and rising stock value. However, with rising optimism, confidence also increases, and good deals will disappear rapidly, diminishing the potential of profit. At the same time, investors have become increasingly confident from their initial successes and will continue trading frequently at high demand, overvaluing the stocks beyond their actual worth. At this point, a so-called market bubble of overpriced asset forms, and it's only a matter of time until it bursts, and many investors incur serious losses. The burst is followed by a crash in stock value and high pessimism. The next bear phase with stocks losing value has started.
Investors' behavior is also greatly influenced by major events causing uncertainties about the future. The election of Donald Trump as President of the United States created more economic uncertainty than the financial crisis in 2008, and the level of uncertainty was only surpassed by the 9/11 terrorist attack. Why? Because the population is worried about the future of their country, about uncertain economic policies, and possibly revised tax reforms. The level of uncertainty in a market is measured with the Economic Policy Uncertainty Index, that measures the occurrence of words related to economic uncertainty appearing in newspapers. High uncertainty is not necessarily a sign of a recession, but does have a measurable impact on the economy, such as overreaction to unexpected events in the news.
So now, do you still believe you're a rational person? Unfortunately, we cannot change our rational nature. However, by being aware of the behavioral biases that influence us, we can become more rational with every decision we make.